Been holding our okay up until now. So while we did climb above that level of 5,400, that's how we started off trade. It's currently softened out post the IIP data. The Nifty now just about latching onto the green, and we've dipped to below the 5,400 mark as well at 53.96 currently. Tata Motors, Coal India, Dr. Reddy's, TCS, Unilever as well as L&T still holding out, but the pressure really is coming in from names like Siemens post the block deal, JSPL, Hindalco, Cipla, you've got an Axis, Sesagoa as well as Sterlite. It's largely dragged down by metals, you'd have to say.
Okay, the big market, macro data that the market had to digest today is, of course, the IIP data. July IIP is coming pretty flat at 0.1%. Manufacturing and mining continue to be a bit of a concern there for the market. And, of course, all eyes now shift to the RBI policy next week for more macro cues for the market. Let's bring on board our banking editor, George Cherian, to analyze this IIP data in greater detail. George?
Well, Sadi, the number is clearly better than what we had in June when you had a minus 1.8%. So 0.1% is better than the previous month's number. Of course, it's a lot. It's not as good as what the market was expecting. You had expectations. The ET poll was throwing up an expectation of 0.3%. Most of the people in the markets were expecting a reading of at least 0.5%. Now, having said that, I think the expectation that the RBI is going to do anything on Monday, I think, is a little is expecting a little too much from the central bank, because you need to remember and again go back to what the RBI has been saying for many months now, that in view of inflation continuing to hold up at levels that it is, it's not going to be able, the RBI is not going to be able to tweak monetary policy in order to accommodate growth. So the focus for now is going to stay squarely on inflation. It's also been, for many months now, been asking the government to get its act together on the fiscal front. We need to see something, some sort of clear, decisive action coming from the center. And I think to begin with, what everyone's expecting is that fuel prices are going to be addressed. We haven't seen that happen for months now. And again, until we see some sort of traction on that front, I don't think you're going to see anything from the RBI. But having said that, most of the market is expecting that you'll see at least a quarter-point cut on the policy rate in the current financial year. There are those who expect that you'll see even a half percentage point cut. But that is, again, a contingent on some action coming from the government. So on Monday, I don't think you should expect anything.
Okay, George, thanks as always for that perspective. Now, of course, clearly the stance shifts to what the Reserve Bank of India is going to do in its month-end policy. On that note, let's also hear out what market experts and economists made of the flat IIP data which came in today.
What is of concern is the consumption story, which has remained strong, which has remained supportive of growth so far, has begun to show signs of weakening. Yes, it is still supporting growth, but once that major driver begins to slow, I think that is where the concerns lie for our overall growth outlook. And 0.1, yes, it's an extremely anemic number.
The absence of negatives, a weaker rupee, and some move on the policy would actually revive this number a bit. Having said that, I also made this point that we also see the rural side actually showing some signs of slowing down. We will see this manifest into poorer numbers on the automobiles, FMCG, fertilizer sales. Staring at a possible downgrade and things like that, there could be some policy action, but I cannot say that will be enough to reverse the slowdown.
I do not see this trend of the slowdown getting reversed in the near future, given the fact that there is fair amount of policy paralysis, and there is also a reluctance on the part of the private sector to invest in capital formation. This reluctance will actually manifest itself in a sharper slowdown maybe 1 or 2 years down the line than what is getting reflected now.
As far as the consumption story and the, say, on the vehicle segment or this kind of thing, I believe that post-October, traditionally in the festival season, these things show a uptick, and I believe that going forward in that period, the whole indices should show a much better outcome than what we are seeing today.
I would certainly recommend that RBI should intervene and should give an indication by reducing the interest rates by at least 100 basis points across 1 or 2 instances. They have to do that. At least RBI is an independent entity. They have the right and they have the capacity to at least initiate this action. That's my opinion.